Okay, what's going on, guys? I'm 1 minute early today. It's Wednesday. I'm excited. We're going to complete all the finishing touches on this assisted living facility financial model. Really, it's a simulation. There's so much going on here. You guys have seen me build this from scratch since last Monday. I've done it on stream every day live. We started with a completely blank Excel sheet. Now we're 8 days later, and this thing's just about done. Today, I'm going to do visualizations. I'm going to do something with the cap table distributions here. I'm going to put those on a monthly basis, and I'm also going to add a cash flow waterfall. Before we get into it too much, let's send out a link to Twitter, do a sound check. Send out a link to Twitter, do a sound check. Sounds good. Video's good. Put this out. Hope everyone's having a great week. Happy Wednesday. Don't forget, check out more models at smarthelping.com. I've done over 100 different unique builds like this, well over 120 now. And this is the first brand new financial model I've done since last November because I've been doing upgrades on all the startup models for the last 7 months. So I'm happy to get back into it. We're going to start adding more models now. You can buy all the spreadsheets I've ever built for $9.99. You can buy also by category or individually. I've got all sorts of different things here. The model I'm working on now is the assisted living facility. It's more of it basically fits into two categories. So I'm going to put it in the real estate bundle as well as the industry specific financial models. It will be a $75 template when it's done. I will have it out and live today. It will be available for purchase today. All right, well, that's all I got for you. Let's get into the model now. So what we're doing today, let's first of all, this cap table, this is where I left off yesterday. And this is a 10-year annual. I'm going to keep this annual summary, but I'm going to move it down. We're at the insert. Okay, let's try to give some space here because the annual is fine, but I want a monthly, and here's why. You can see your cash contributions here, but on an annual summary, you can't really see all of it because this is aggregating the monthly and the annual. So you see a net, but you really are going to want to see your actual monthly contributions because you're going to want to match this number up here with what you actually contributed, which it will, but we have to do a monthly schedule to show that, and we'll do a monthly IRR per individual line item as well. So that's going to be useful in my opinion. We'll also have the 10-year. I'm just going to put, we'll just label this 10-year annual contribution distribution summary. And here I'll just put, each of these next to it. Okay. Perfect. All right, so that's the annual can stay, but we're going to add a monthly here. That's going to be, I believe, very valuable to have. And we got our sanity checks in already. Everything's been done on the model. All the sanity checks were fine. So we're just adding these final features. So here we go, month one. So these are months. And we'll put the years up top here as well. Oop. So to do this, let me zoom out a little bit so I can see better. So now this is going to be a little bit easier. Before we had to do a crazy sum ifs formula to get this thing properly zeroed out because we were pulling from this distribution schedule, which is on a monthly basis. Now that this is monthly and we're doing a monthly here, it'll be easier. I don't have to do a sum ifs. So essentially what I can do is take this formula. It's going to be, instead of sum ifs, I just simply reference distribution 6, which is this, just reference the cell. And then with this plus sum ifs, we don't need all of row 5, we just need 5. And now each of these should be 1 month. And if we scroll this all the way down, 10 years worth of time. Couple more. There we go. We have the entire cash flow schedule, and we can put it on an individual basis. Now, why is this cool? Well, now look, you can see if we sum up all these negative months, you see it's 800,000. The contribution was 1 million, but if we keep going, you can see there's going to be some more negative cash flows coming up here. There's the 199,750. So if we add up total contributions and sum all this up, what is this going over to? EC if N11 to EC11 is less than 0. There's the million. So now you can tie out exactly your contribution amount. You can see how it's being populated, and we can sum it up here to do the check. And this, we'll put a little space next to this. What's the format here? 11. Okay, and let's give these a, we don't need to see the decimals on this. Now, what I should be able to do is drag this down and over. Let's see what happened now. I need to lock distributions C6 and 5. Okay, that looks good, and this is the total. Now, if we go over, there we go. Now, you can see this, if we put a little right border on this, we could do a thick right border. This total equals that. So whatever you put in here, that's the total just contributions that are going to happen over here on a monthly basis in aggregate. And you could look at exactly when that happens. Like if this was say 800,000, now you can see the numbers change. Now the IRRs, we're going to have to do another column for that, and we'll put it over here. On the annual, I'd always put it on the end, but it's too far over. I'm not going to do that. I'm just going to put it right here. and we'll have to convert it to from monthly to annual. So we just go IRR of this whole thing. So that gives you the monthly internal rate of return. And obviously the no cash flows are, we'll put an error, if error on that. Give it a decimal. Okay, now we have to convert this. This is a monthly internal rate of return. Nobody really thinks of internal rate of return on a monthly basis, so we convert it to annual. Now to convert it to annual, let me see. So 1 plus the rate raised to 12 minus 1. Let's go over here. So 1 plus the rate raised to 12 minus 1. Oh, something's wrong. Let's see, do we need this? One plus the rate. So this whole thing needs to be raised to 12, then minus 1 at the end. Hold on, let's get back in here. I must be missing something. So that's double bracket. Let's just pull the whole equation in. So here it is. We just adjust the reference. And this goes out to EE. So double bracket 1 plus the rate, closed double bracket raised to 12, closed bracket minus 1. And then we go if error 0. There we go. That looks better. So you can see the aggregate internal rate of return, and these are more accurate because they're based on monthly cash flow. So that's the most accurate IRR you're going to get. Perfect. Okay, let's go ahead and do, so same format. Let's start here. These are fine. This is good. And then we update this formula now to be this. A little bit different formula here, but we're going to remove the sum ifs. And then this will be done. We'll add the cash flow waterfall version of the distributions and then some visualizations. Okay, so we take the total here, lock it going down, keep this, and then plus 5 here, and lock that. So this should match up with this. Oh. Now this 5, we can easily sum that up. This can be the sum of everything up top here for the aggregate. Now that should match our aggregate investor, so 11% in 5,424,000. Yep, 11%. 5 mil, and then there's another million out. So that's 4,355. Okay. Now we drag these over, and this should be all set. I think it's good to see the monthly granular level, and then if you want to roll up and see the annual, you can do that here as well for each individual. Now there's the checks. We also want to put checks on this. So we can say this minus total investor should match, and this minus total owner should match. Excuse me. Alrighty, drag these over, and we can add those to the sanity checks. That should always equal what's on the distributions. And there we have it. So this is all dynamic. It'll be based on the assumptions changed over here for contributed and percentage equity share. And looking good. So we'll add this sanity check, monthly individual. And we simply sum up all of this. And it should always be 0. All right, so that's really good. The model is done in itself. You can use this right now, but I want to add a couple more things, visuals and the waterfall. So let's go here and add a optional cash flow waterfall with IRR hurdles. This is more akin to real estate deals, and how the sponsor, which is the general partner or operator, will share the cash flows or contribute versus receive cash flows compared to the investor or LP. And LP just invests money, the GP will run everything. And we will pull from a monthly waterfall. Let's check out the real estate. I believe self-storage, this one has a monthly waterfall we can use. So, yep, perfect. So we're just going to use this structure. Got a discounted cash flow analysis in here as well. Oh, we don't need 180 months though. We only need 120. So this is all contained in one sheet. So we copy this over. And formatted it a little bit. Now on this one, let's widen these columns. So all I really need is the feed of contributions, distributions. There's no real period 0. This is month 1 starts here. And then this all goes forward. This is just going to equal our first month of the model. That's fine. And all we want is the monthly, so negative cash flows is the contributions that are required by the equity providers. So we look at distributions, we just use this. So all negative ones go here. All positive distributions go here. And those are all the cash flows for the whole thing. Now, what the waterfall will do is track the ongoing internal rate of return that the investor has received to date by month. And then every time they reach a hurdle, the cash starts to be split in a different way. And what this does is it incentivizes the operator to do a really good job for the LPs. It also, the LPs are saying, well, if you give me higher returns, I'm willing to accept less cash flow. So it's a really nice incentive structure. It's used in real estate a lot. Now this is all going to be completely, well, we could, we, let's see if we can tie it to the cap table. I don't know if it's possible, but maybe. So we know the contribution rates are based on this. The investors are doing 70.7. Look at these decimal. This actually might tie into the model. I was going to make it 100% unique, but if we know the contribution distributions or the contribution rates here, then we define the hurdles and the share of cash. So now what this little waterfall here is replacing essentially these two numbers because these are static. This is saying for the whole life, the investor will get 41% and the owners will get 58. Now, in this optional waterfall, we can say, well, up to a 10% internal rate of return that the investors received, the investors are going to get 80% of the cash flows, GP's 20. And this could be 100-0. It could be like a hard preferred equity where they get up to 10%. They get all of the cash flows or what have you. It's going to be dependent on the deal. And then once they get past 10%, up to 15%, they'll split it this way and then this way and so on. And so what that does is that is a more sophisticated and incentive way to do what you see here in just the fixed percentages. All right. I want to make these a little bit smaller. So let's see what else let's make sure this all looks good. So yep, these are converting the annual hurdle rates to monthly hurdles since these are monthly cash flows. We can see the LP's equity balance change over here based on what they've contributed. And then you've got distributions. Now this should be, yeah, this is all self-contained, so all this logic should be good to go. Discount rate. So discount rate, we could actually use what's on the distributions tab. So investors, oh wait, sponsors are this rate, investors are this rate. And then this all works. Let's go now to GB, which we need to go out to, yeah, DU is actually shorter than that, so that will be fine. Now 120, let's see, are we offset? We're offset here, so this is actually period 1. Okay, there we go. So 120, and then this is, we don't need this 121 here. All right, and you can see we actually get into the last hurdle by the last by the exit, and before that we're actually in hurdle. Well, let's freeze this so we can see what we're looking at. So this is really awesome. I love this. So you can see here, here's the distributions, I mean contributions, and then we start hurdle 1. Here's how the cash is split. Let's also make sure this is all formatted 11 Calibri. And these two I want to make a little bit smaller. All right, we don't need this either. Okay, so you can see now we've started to get to some distributions. We're in tier 1, cash is split 80-20. And that happens until, we go along here. Logic's all working. And now we have some more contributions. So we're, still stuck in hurdle tier 1 for a while. Now here, finally, by month 71, we get to the second tier. And this means if you go up here, you can see the check for the hurdle rate, 10%, is looking at the IRR of all these tier 1 cash flows for the investor. And they match. You can see this is 10%. Now, if this were to be 11% hurdle, you can see we go out to actually month 75 now to reach it, and then everything goes beyond that to the next tier, which is split, a little bit more favorable to the sponsor. And then you go along here, then by month 94, we get to the third tier, and so on. And then finally, by the end, that's when we finally reached the past the 20% hurdle rate. And you can see the IRR for both investor and sponsor here. So this logic is really awesome. Then we can actually apply discounted cash flow analysis to those final cash flows for the sponsor and investor. Very, very nice, clean logic here. First time I've actually put one of these into like a startup model. Usually I just reserve them for real estate models only, or I just sell the templates completely separate, or the waterfall stuff separately. But here we've integrated it as option, and it looks pretty smooth. That was very painless to integrate. Now we could do a check. We should do a check on this. So we'll do, we want to make sure the optional cash flow waterfall against ending cash monthly detail. So if we sum up all of these here, which total investor, total sponsor, that amount should be equal to the ending cash balance on the annual detail. Perfect, and there you go, it is. So that's good. That's a nice check. And you can see these are summing up the total cash flows in aggregate. We've got equity multiples here as well. Equity multiple IRR. Or if I could put, let's put some text in front of this. We can't. Oh wait, let me close the parenthesis. There we go. Let's just make that really clear what that is. Okay. Looking good, looking good. Now, if you had more tiers, you can always add more. It's a little hard, but you can do it by following the logic. And if you don't need that many tiers, you can just, put the split at whatever it is after a given rate. But yeah, I'm really happy about this. This looks great. Let's get our line style back. All right. Well, I'm happy about this. Let's go on. So this is done, completely integrated. We've got no references to any other workbooks. Oh, so find, now we might have some references to other workbooks and other stuff, so let's do a .xls search real quick across the whole workbook. Ooh, yes, so here we got to update these calculations. So project IRR is this, equity required right there, cash returned right here. We can make this a positive value. Investors, IRR, equity required for investors. Now here, it will be this number. And then investor cash returned, we have to sum up, well, do we have that anywhere? I guess not. We'd have to do a sum if. Sum if any monthly cash flow that is positive. Now I like this simplified version of just saying, look, any monthly cash flow that's negative is a contribution. Anything that's positive is a distribution. That really makes it simple and everybody can understand that. So I'll probably use that going forward. Actually, that's a really nice setup. So it's cool that we got it on here. Okay, owner IRR, owner equity required. And then this will be the same as this one, except row 22. And then let's do a check here. So this plus that equals that, perfect, and this plus this equals this. Okay, so that's good. Let's keep searching. I need to see if there's anything else referencing another workbook. Nice, there is not, so that's great. Now, we have one final tab that we're doing here, visualizations. Now, visualizations are where you really start to see patterns, and so when you start playing with the revenue and expense assumptions and different things, you can really see a high-level visual look at what's changing with the staff and all that. So let's format this. So I want a standard format for these charts. We want a good size here. Usually K to 22 is a good format. What's going on, people? By the way, happy to see you here. We're finally going to finish this model. We're on day 8. 8 total days of streaming to get this thing to the finish line. Oh, and just to update you, the next one, so this was assisted living facility. I've got a couple in the works that I want to go into, either a real estate agency, plumbing, a hotel financial model, which a hotel financial model I could probably modify one of the real estate models I already have. It's almost the same thing. I might do also a football field valuation, which is a cool value. It's not has anything to do with the actual sport. It's a cool different chart you can do for valuation sensitivity. And then possibly a property management business. So all kinds of different things in the works, and we're going to keep grinding out new models. I'm really excited to get back into this after 7 months of upgrading all the models to have a 3-statement model. Now that that's done, we're going to get into new builds just like you've seen the last 8 days, and we're just going to keep doing it. All right, so visuals. We want some high-level stuff. We're going to go with revenue by type. Actually, we can do this. We can aggregate this whole thing here on the annual income statement and do a stack chart. And this is simply annual revenue by type. And there's 2 types of revenue. Wait, why do we have 3 there? see. Oh, so we don't need this row. All right, let's kind of make this thing. Let's see, how do I want to do the formatting? It's a 10-year. I think I like the thicker bars. That's probably good. Let's do the background. How do we want to do the background? Now I'm red-green colorblind, so what I'm seeing is probably a little bit different than what you're seeing. What's this? Orange, blue. I don't know. Maybe we change these as well. Okay, that's not bad, I think. Let's get rid of the decimals here. So we have revenue by type. We're gonna do, what else do we want to put in here? Let's do EBITDA for sure. Annual EBITDA by type. What else is good? That we kind of want to see. We'll probably have to go over to the executive summary. I definitely want to do something with the debt service and cash flow. Let's go. So here's your revenue, EBITDA, which is showing the expenses. We can also show, let's do another one here. Let's do total revenue versus total expenses. That's a good one. So the difference is essentially the EBITDA, which is earnings before interest, tax, depreciation, amortization. All right, this looks good. We're going to outline all these. This is annual revenue versus expenses. And this is not going to be stacked. No point to stack this one. This will be side by side. And you can see the difference of all these would be this bar here. So you can see here we've got 3.6 and 1.2. That's about a little bit over 2 million. So you can see that's that bar. So the difference between each of these is this. Okay. Let's do cash flow. Try and get these things looking good on the spacing. So cash flow right down here. And then we might get into some advanced stuff once we get all these high level charts out of the way that are more specific to the industry. Let's see, format access. I want this on low. Okay, annual cash flow. Also, I just saw this could be removed. We can also do on this chart annual cash flow versus cumulative. So we can add a second one here. Oh, and again, we don't want stacked here. So there's, let's give it a legend. So there's the ongoing cash position and then the cash flow each period. And I want to relabel this cumulative. Okay, let's think. What else could be? I think another relevant calculation would be the balance sheet cash flow by month. I love doing the visualizations. And this is a little bit different because this number is just a project level. It doesn't include equity. What we're about to add is equity into the equation. So balance sheet cash. Let's get, hold on. Start over here. Let's get the dates. Now, I've never really done a visualization for financial statements, but I'm going to in this. I'm going to show total assets, liabilities, and equity over time. That might be cool to see. And then this has got to be switched to monthly periods. And we could do every 3 months so we can see a little bit better. And let's just do this across the whole way here. So there's a balance sheet cash flow by month. Pretty cool. Let's do some other ones here on the balance sheet. So we could do total assets. Let's see what this would look like. So we have total assets. We could probably do this on an annual basis, but whatever. Um, liability. And owner's equity. So three main parts of the accounting equation. Now, I don't know how to format this best. We'll see here in a second. It's the first time I actually did visualizations on a balance sheet like this. So this is assets, liabilities, owner's equity. All right, let's think about this. We could do, what would make sense here? A stacked, maybe a line. Probably not as stacked. You know what? Let's change this to annual so it's easier to comprehend. Let's remove these. So we have assets. Oops, I actually targeted the wrong row for assets. Liabilities. And then equity. Now we could do liability plus owner's equity, but it'd just be the same number as assets. Okay, let's switch this. This is now annual. Well, legend. So you've got assets, liabilities, equity, and assets equals liability plus equity. And you can see the equity rising here over time. And eventually you just have no liabilities because you're paying it off, and then assets will equal your equity. Well, that's cool. We can keep this like this. I think it works just fine. All right, so some cool visuals here. I actually like the color formatting on this. I don't know if it looks good to anyone else because I'm colorblind, but it looks good to me. I kind of want to change this to that green. Let's see, what do we have here? Third one down. Kind of like that better. This is fine. So we got 3. Okay. So balance sheet, cash. What else do we want to put in here? We could put in revenue or operational income, which is EBITDA against debt service. That's a good one. If you're going to be financing anything. So here, I'll do it on an annual basis. We want EBITDA. So how much are you producing in operating income versus, and we actually might have to do a new row for this. Yeah. Oh wait, here's the debt service coverage ratio. So we want that in here as well, but okay, so this can stay, but I need to show total debt service payments. This is going to equal here plus principal and interest plus principal and interest. And then that 2.8 should just be the EBITDA divided by this. Yep. 1921. Okay, so it's the same. Perfect. So essentially, it's saying this operational income is producing 2.8 times the amount of debt service payments. So if we put it on here, let's add, so that was EBITDA, let's add debt service payments. Okay, and this, that's good. I'm also going to change the chart type to a combo chart, and I want to show these will both be columns, but I want to add a new data point called debt service coverage ratio, which we have here, and make that on a different axis. So we got combo debt service coverage secondary axis, and we'll make it a dotted line. And let's format those markers. I want to do diamonds, bigger. The fill I want to make gold, and border I want black. And then this is debt service coverage ratio, and this is just a dollar amount because we have debt service and EBITDA. Okay, and let's change this to green just to match the whole formatting. Also, we'll give these brackets. Okay, this is EBITDA versus debt service and ratio. Pretty good, pretty good. This will give a lot of insight into what's going on with the business as a whole. Now, the question is, do we want to get fancy with, what can we do here? So we can do revenue by room type, definitely, and we'll do that on an annual basis. So let's add, and I want to do it like this. No, it'll be like this one actually. So we got to add all these up. We have revenue for the first room type. Oh, why is this all weird formatted? Come on, Excel, don't do this. Don't mess up with me here. Let's try this again. Add annual, there we go. So we want this. Room type 1, room type 2. It's doing it again. Come on. Come on, Excel. What's going on, guys? Thanks for watching. We're just doing, so far today we've done a cash flow waterfall edition on a monthly basis. I did a monthly distribution on the cap table for each line item and the internal rate of return by line item. And now we're just working on some visuals. Let's see if we can get this going here. Okay. It doesn't seem to want to add more than one at a time without messing up. Did we already do room type 3? I don't even know. No, so 3, then we got 4, and then 5. So we're going to do a stacked line chart showing the total revenue by each room type. I'll also do something with occupancy over time. I think average occupancy, or oh, we'll see. Let's just do one at a time here. So there's annual revenue by room type. So the total revenue is still the same as this, but now we can see where it's coming from by each type of room. Now this font, I wonder if we make it smaller, or would it look better longer? Oh yeah, that looks nice. Okay, so annual revenue by room type, looking good. What else do we want to do? So occupancy, we could do an average. What's the best way to do this is, I guess you do a weighted average based on the room counts. And let's do this down here for chart data. So we want to show each room type here. Oh, come on. A6, A14, A22, 30, and 38. Okay, so occupancy, I think we just do average ifs. Let's see what makes sense. So average this. I guess based on the room counts. I don't know what else. Oh, wait, we do some product here, not average ifs. So we want this number weighted against room count. So some product of that divided by the sum of this. And then we could lock A. And we'll do that for each of these. So your weighted average room count is that over time. Then we do the same thing. Let's do type 2. Drag these down. Now I wonder if we could do probably some kind of grand total. I don't know, we'll see. Let's get these in first. Okay. Four. Now, hold on. What? That doesn't seem right. Ah, I need to drag this over. So that was 4, and then this one must have missed it. Yeah. Okay. So there's your weighted average occupancy. We'll do a chart on that. I think just a line chart makes sense for this one. We could do the total range and just sum up the total here. And then do the dates. and we want a line here. What happened? So we don't want this. And then this is going to be the reference here. Okay. Weighted average occupancy by room type. Now that'll be easier to see if you have actual data in there, and they vary, but you can see it in general. Now let's do the whole. So if we weight the entire if we weight the entire thing, I think we just go sum of the total occupancy of each room type. So room type 2 bed, 1 bath has 103 units. If this is the average occupancy of that, we can then do a weighted average against these rooms amounts. Oh, what are we doing here? So 1, 2, 3, 4, and type 5. Okay, and then weighted average total, some product. So this is across the entire portfolio of rooms. Oop. So that number there. And then we do a chart on that. And what I'll do is just remove all this. We're going to just go weighted average total and percentage. Here's the axis label. And this one we can do data labels. Nice, that looks good. Increase our font here. This should be a percentage. Same with this. What's our font size? 12. Let's adjust this one. All right, looking good. So we've got occupancy, we've got revenue by room type, occupancy by room type and portfolio. Pretty good. Pretty good. Anything else that really would make sense? I like our waterfall here on the debt service, or just the style. So you've got interest only loans, the principal and interest version once it converts from interest only, and then the refi. And all this is obviously optional. You can configure it however you need. So that's pretty good. I don't know if I want to make a visualization for the debt service or not. I don't think I will. I think we'll leave it like this. Let me adjust these line styles. So do bottom border. Okay. And right now, actually, our refi is less than the um, repayment of the initial loan just because of how we have the assumptions set up. So let me just adjust that. You see, this is our new schedule for the cap table. We did IRR on a monthly level in contributions, distributions on a monthly by row item of investors and investor types. So that was what we added in today. Make sure this is all formatted. All right. Um, what was I saying? Oh, the debt service. Let's see. So right now on on the refi, we got an LTV of 80%. We're doing a multiple, even a multiple of 3. Let's do like 8. Now I know technically, so this is similar to what you're going to get if you put a cap rate in on a net operating income a of real estate, building. But it's more so this is an assisted living facility, so it's almost like it's not necessarily an item where you're just investing in a building and collecting rent. You're investing in and operating this building. But there's a lot of dynamics in this type of um, business that's just similar to real estate. But obviously, we have all the assumptions for, staffing, and it's a lot more in depth than just a regular real estate building that just has utilities and you have some OpEx, but not like in-depth staff like nurses, therapy teams, other outsourced professionals. So it's a little bit similar, it's a little bit different. But I thought the financial structure matched best a real estate as far as like the financing goes, how the debt works, and then valuation and all that. So uh, and development and acquisition costs are very granular and on a monthly basis. Based on those costs, you can schedule when the revenue starts, which would be after all the development is done. You could decide to use the construction and development loan or not. You can obviously assume to use the refi or not. Now, at an 8x EBITDA multiple basis for this valuation, let's see what the cash flow looks like here. 16, yeah. So that kind of is more along the what you normally see with the refi being a lot more. So usually there's investor distributions on a refi if it does happen. Now you don't have to have that. Again, you could hit no on the refi, and then you go over here and there's no refi. And we just have the regular loan that gets paid off. And you can also set it to you don't have to include a terminal value either. You could hit no here, go over. You can see now there's no exit. No exit value, no repayment of the loan. And you can see on the balance sheet, it's just all the numbers as of the last month of the forecasted period. And then you can see here all our sanity checks are zeroed out. So this model is really dynamic. It's really awesome. Definitely, I've taken everything I've ever learned in modeling is you see it in this one, and I've structured it so that it can't really break. Um, it's got so much granularity, but also optional granularity that you don't have to use, but you can if you want to. So it's really just the structuring is elegant, the model is elegant. If you're going to start a assisted living facility, this is definitely a model to start with. And there's a lot of logic in here I'm going to use going forward as far as what I did on the distributions, contribution schedule. Um, I like this format. I like just taking any negative cash flows of distribution, any positive ones are cash return, and that's just the basis for all the equity returns and the equity contributions on the balance sheet. You see this is dynamic based on what's contributed over time. I really like the way this was structured, so this is really cool. It's a 10-year model, and I'll probably be using a lot of the structure that's surrounding the bottom-up assumptions going forward quite a bit. And I mean, I think we're pretty much there. I don't know if there's any other visualizations that I really want here. It's just high level. You know, you've got revenue, EBITDA, cash flow, revenue versus expenses, balance sheet cash by month, assets, liabilities, owner's equity by year, EBITDA versus debt service and debt service coverage ratio. You can see here when we took out that big refi that's actually negative, which is not good. You obviously don't want to you're operating at a loss there. Um, which if we go down here, you can see EBITDA, 1.4 million, debt service 2.1, so that's not good. So we probably aren't going to do, uh, that gives us a lot of cash flow on the refi, but we have a debt service is too high. And this is what the model's for, to do these tests and see what's feasible. Let's try maybe a 6x. Still a little bit negative there. Because the refi, basically you get a lot of proceeds on that refi period, but you then have higher debt service. Okay, this looks good. So here you can see the final cash flow. We have a little bit here, a little bump in year 3, which is the refi. You got 10.5. You pay off all these loans in this. Here, 7.8 million you owed. Um, these prepay penalty fees are hitting. Let me see if I zero these out. So they're hitting here, but on the income statement, they hit, I believe I added them into other SG&A. Yeah, 280 and 287. So 280, yeah, these penalty fees hit the income statement separately. And then you got with the SG&A. Now here on the cash flow, they're counted up. They're counted right here when they happen. And so this EBITDA is actually going to be, should be a little bit different. Let me double check. 21,181. This is 2820. Yes, this is a little bit lower. And that's exactly how it should be, because this EBITDA number does not include the prepay penalty fees, but the income statement does. And the income statement is actually what we use for the multiple for valuation. So that's good um, that's the way it is, because that'd be more accurate. And then obviously the final cash flow numbers all match up. We've got all our sanity checks to make sure that is the case. So pretty cool model overall. Let me go over here. I just want to double check one thing. Yeah, this is the same. Okay, let's get everything up and over. Make sure it's all nice and neat. Because sometimes people will get into these, and then if we froze a row up top and we scroll down, they'll look at a tab and think, they're like, where's the other data at? So I always want to make sure everything's up and to the left. We got all our visuals here, very awesome visuals. Cash flow. Debt schedule, startup cost, terminal value. Let me put a broad label on this. This is monthly contribution, distribution, and IRR summary by line item. Okay. What a great, this is really a financial simulation. I call it, it's more than just a financial model, it's a simulation. Got depreciation in there. All right. I think we're all set. So what I'll do later today, I'm going to add an index tab that has a summary of all the different tabs and what they do. I'm going to do an overview video of the whole model, hopefully in less than 10 minutes. I try to keep them under 10 for the purpose of that. And we're going to keep grinding. So this was assisted living facility fully out. I can't wait to add it. It's going to be part of the real estate bundle from smarthelping.com here. I'm going to add it into the real estate bundle section as well as the industry specific section. The price will be $75 one-time fee. The value you're getting out of this model is insane. There's so much value here for so many different reasons. Um, and then remember, guys, if you want to check out all the models, I've done over 120 of these things, startup models, but also templates for all kinds of different things: inventory tracking, sales pipeline management, just general cash flow waterfalls, valuation stuff, all kinds of models here. You can buy everything for $9.99 on the site, or buy by category or individually. All right, well, hopefully you guys had fun, and I'm happy this thing's done. I'll get it out. Hopefully this should be live by the end of today, the assisted living model. I should have this up and ready, and it'll be on the site, ready to go for 75 bucks. Alrighty.